The stock market has barely blinked with all these blow-ups. The credit market kind of dismissed them as idiosyncratic until Jamie Dimon warned about the prospect of more cockroaches. And then that kind of got people's attention just a little bit here. At what point does this become something that the credit market starts to panic over?
Well, we haven't seen it yet, as you say. Credit spreads are still almost record lows. So people are still partying. You know, if the punch bowl's being taken away, only a couple people may have noticed it yet. But so far, it's still partying like it's 1999 in the credit markets for the most part.
What I found really fascinating was that Jamie Dimon didn't really target private credit in his comments. He kind of just made the comments generally. Yet the industry got kind of defensive when he spoke up. Are these firms justified in doing so? I mean, you point out that they have promised these equity-like returns. That raises questions about the economics of their business.
Yeah, there's two things that bother me. The way private credit is being sold to investors, and I sit on investment committees, so I see this. And really, it's one of these too good to be true type promises. We're going to give you senior debt exposure, often secured somehow, but with equity rates of return, double-digit type returns, which makes you wonder about the underlying credits themselves. That's number one. And then related to that is how much leverage is being used within the vehicles to juice the equity-like rate of return. And then the other thing that's concerning to me is the explosion now in captive regulated subsidiaries by the largest players in this area, owning insurance companies, and where there really isn't a true arm's length difference between the people buying the credit and the people selling the credit to them. And that is worrisome. That's something we saw in the Drexel days, by the way. One of the things that got us so concerned in 1988 and 89 in the Drexel junk bond kingdom was the fact that more and more of Mike Milken's clients had regulated subsidiaries like savings and loans, insurance companies, thrifts, trust companies, where they were buying the same credit that, in effect, others in the kingdom were selling without a lot of arm's length disclosure. And so that is something to keep our eye on, I think, is the use of captive regulated subs to buy this stuff.